This episode is brought to you by CertFuel. They've got a full Securities Industry Essentials course with adaptive study quizzes, smart flashcards, and unlimited practice exams weighted just like the real thing. Check it out at certfuel.com.
So I want you to picture this. It's 2008.
Right, the absolute peak of the financial crisis.
Exactly. And thousands of investors actually got it right. They predicted the market, they bought a product tracking a commodity index, and that underlying index performed exactly as they expected.
Which, normally means you cash in.
Yeah, but when they logged into their brokerage accounts in mid-September, their investment had just vanished. I mean, it wasn't down 10%, it wasn't down 50%, it was a literal zero.
Completely wiped out.
Vaporized. And the crazy thing is, they were completely legally wiped out, and it had absolutely nothing to do with the stock market.
It's honestly one of the darkest, most cautionary tales in modern financial history. It really is. And today, we're going to tell you exactly how those investors were financially ruined by a product called an ETN, and more importantly, why understanding that tragedy is basically the key to passing the Securities Industry Essentials exam.
Because it perfectly illustrates why you just cannot simply memorize textbook definitions if you want to survive the SI exam. Or, frankly, the real-world markets. You have to understand the actual underlying mechanics.
Exactly. So welcome to this deep dive. We have a massive mission today. We are tackling exchange-traded products, or ETPs.
And just to set the stakes for you, this topic sits inside a 33-question block on the exam.
Yeah, which makes up a staggering 44% of your entire SIE. If you master this, you are well on your way to passing. But look, we know that reading textbook chapters about, the Investment Company Act of 1940 is brutal.
It's incredibly dry.
It'll put you right to sleep. So we are not doing a dry lecture. We're going to use ridiculous analogies, real history, and a few recurring characters to make this stuff actually stick in your brain.
Because that's the ultimate cheat code here. If you know why a financial product was built and how it physically operates in the plumbing of Wall Street, you can answer exam questions you've never even seen before.
Right. You won't fall for the trap answers because you'll just recognize that the trap contradicts the very nature of the product.
Exactly.
So to help us navigate this Wall Street plumbing, I want to introduce our cast of characters.
Yeah.
You're going to hear about these folks a lot today. First up, we have Day Trading Dave.
Ah, Dave.
Yeah, Dave is highly caffeinated, super impatient, loves leverage, and basically tries to time the market every 5 minutes. He doesn't care about a company's 10-year outlook at all.
Right. He cares about a 10-minute price swing. We see a lot of Daves out there, highly active, highly sensitive to intraday pricing.
Exactly. Now, on the complete opposite end of the spectrum, we have buy and hold Betty.
The quintessential long-term investor.
Yep. Betty manages a multi-generational family trust. She's patient, hates paying taxes, loves low fees, and basically just makes one lump sum investment, takes a nap for 20 years.
She lets compounding do the heavy lifting.
Spot on. And finally, we have bankrupt Cobb.
Oh.
Yeah, Bob is the banker. Slick suit, writes a lot of complex legal promises, and takes in billions of dollars. But under the hood, Bob's promises are only as good as the cash in his firm's vault. He might not have the cash to back them up when things go south. Keep your eye on Bob.
Yeah, Bob represents the exact counterparty risk that destroyed those investors back in 2008. But to understand the products Bob creates, we first need to understand the bedrock of the entire ETP universe.
Right.
We basically have to look at the massive problem that exchange-traded products were invented to fix in the first place.
And that problem was the traditional mutual fund. I mean, mutual funds have been around forever, right, since the 1920s. So why do we even need ETPs if mutual funds have been the gold standard for a century? What was the inherent flaw?
Well, it really comes down to the speed of liquidity and the rigid mechanics of forward pricing. Think about the technology or lack thereof in the 1920s.
Right, no computers.
Exactly. A mutual fund is a massive pool of money from thousands of investors buying hundreds of different stocks, trying to calculate the exact down to the penny value of that entire portfolio every minute of the day. It was computationally impossible for most of the 20th century.
So they just didn't even try. They were like, we will calculate the value of this massive pool exactly once a day when the market closes, and we get the final prints for all the stocks we own.
Precisely. The New York Stock Exchange closes at 4:00 p.m. Eastern. The fund administrators wait for that bell, add up the total value of the holdings, subtract liabilities, divide by the outstanding shares, and boom.
You get the net asset value, the NAV.
The 4:00 p.m. NAV, one price, once a day.
I've always compared this to ordering at a very strange very rigid restaurant. So imagine you walk into the mutual fund restaurant at 10 a.m., you look at the menu, and you tell the waiter, I'd like to buy a slice of your large cap growth portfolio. But there are literally no prices on the menu.
Right, you place your order completely blind.
You place the order, the waiter says, great, we'll lock you in. Come back at 4:00 p.m., and whatever the chef determines the ingredients cost at that exact minute, that is the bill you have to pay.
That is the exact mechanism of forward pricing. If you submit a buy order at 9:30 a.m. or noon or 3:59 p.m., it just doesn't matter. You are batched together and executed at the next computed NAV.
So put yourself in the shoes of day trading Dave for a second. Let's say it's 10:30 a.m., a massive news event hits, the market is plunging, and Dave wants to buy the dip right now because he thinks it'll recover by 2:00 p.m.
But if he uses a mutual fund, he doesn't get that 10:30 a.m. dip.
Nope. He gets whatever random price the market lands on at 4:00 p.m.
Which is entirely useless for his strategy. And that rigid structure is exactly what led Wall Street to create exchange-traded products in the early 90s.
So if the mutual fund is a restaurant that only sets prices at closing time, the ETP is a frantic live auction taking place out on the street. It trades continuously on an exchange like the NYSE, just like shares of Apple.
And that simple shift, putting the fund on a live exchange, unlocks a completely different dimension of trading mechanics. Prices are changing by the second. Dave can buy at 10.30 and sell at 10.45.
Okay, pop quiz for you. If an exam question asks about intraday trading or continuous pricing, who are we talking about? Pause for a second. Boom. ETPs. Mutual funds are once a day at NAV.
Exactly. But the exam wants to know if you understand the consequences of that intraday trading. Because an ETP trades like a stock, Dave can do stock-like things to it.
Like buying on margin.
Right. Buying on margin means using borrowed money. Since the ETP has a live, transparent price, Dave's broker feels safe lending him money against his ETP shares as collateral.
And you simply cannot do that with a traditional mutual fund because the broker has no idea what the fund is worth until 4:00 p.m.
Exactly. The broker can't manage their risk. The second massive capability unlocked by the exchange is short selling.
Walk us through why shorting is physically impossible with a mutual fund.
Well, to short a stock, you literally borrow existing shares from someone else, sell them on the live auction, and hope to buy them back cheaper later.
Right.
But a mutual fund doesn't have a secondary market. When you buy a mutual fund, the fund creates brand new shares for you. When you sell, they destroy your shares. You can't borrow a share that is created and destroyed on demand, so you cannot short a mutual fund.
Wow. Okay, so if you're in the testing center and a question describes an investor shorting a diversified portfolio at 11:15 a.m.,
you immediately cross out every mutual fund option on the board.
Yep, the live auction is the only place those mechanics exist. But we need to flag a massive exam trap right here.
Oh, this is a big one.
By moving to the live auction, ETPs introduced a highly tested risk, price detachment, the premium and the discount. Explain how the price of the thing can be different from what the thing is actually worth.
It's all about human emotion and supply versus demand. Let's say an ETP holds a basket of stocks, and the true math value, the NAV of those stocks at 10:30 a.m. is exactly $50 a share.
The actual ingredients in the box are worth $50.
Right. But then Jerome Powell makes a surprise announcement. Retail traders panic buy this specific ETP. That massive surge of buyer demand overwhelms the sellers. The sellers say, well, if you want it that badly, I'm not selling for $50. I'll sell for $50.20.
And because day trading Dave is impatient, he pays the $50.20.
Exactly. So the market price of the ETP is now $50.20, but the underlying NAV is still only $50. The ETP is trading at a premium.
And if there's panic selling, it drops below NAV, trading at a discount.
Right. This is where the exam tries to get you. ETP market prices can and do differ from their underlying NAV. Mutual funds, however, always transact exactly at NAV.
Always. There is no premium or discount because there is no secondary market. But wait, if an ETP is trading at $60 when the basket is only worth $50, isn't the product just broken?
If the premium got too large, yeah, the whole system would collapse. Wall Street knew this.
Which brings us to the absolute magic of the exchange-traded fund, the ETF.
The dominant heavyweight champion of the ETP universe.
Yeah, and it has this hidden plumbing system designed specifically to fender that premium and discount problem. But before we get into the plumbing, let's establish the legal foundation. What is an ETF?
Legally, an ETF is a registered investment company. Most importantly, it is regulated by the Investment Company Act of 1940. If you take nothing else away from the segment, engrave the year 1940 into your mind.
Why does 1940 matter so much?
Because the 1940 Act was born out of the ashes of the Great Depression. Before the crash, funds operated like black boxes. Managers did whatever they wanted, and when the crash hit, investors realized the funds didn't actually own the assets they claimed to own. It was a shell game.
So Congress stepped in.
Exactly. The 1940 Act mandated structural safety. It requires a fund to hold its underlying assets in a separate, secure custodial bank.
Ah, the fruit basket analogy. Under the 1940 Act, an ETF must hold an actual physical portfolio of securities. If the ETF claims to track the S&P 500, they have a legally protected vault holding actual shares of Apple, Microsoft, Amazon. You physically possess the fruit.
And when you buy a share of that ETF, you own a proportional interest in that exact vault of fruit. No shell game. The assets are real.
Okay, the foundation is rock solid. But go back to our detached ETF problem. The market price got pushed up to $50.20, but the fruit inside is only worth $50. How does the ETF force the price back down to reality?
Through a highly automated process called creation and redemption. And here we introduce a new entity. It's not Dave, it's not Betty. It's an invisible institutional giant called the authorized participant, or the AP.
The APs, who we're talking about massive broker-dealers like Jane Street or Citadel.
Exactly. Multi-billion-dollar trading desks. They are the only entities legally allowed to interact directly with the ETF issuer. Here's how their arbitrage machine works. The AP's algorithm sees that the ETF is overpriced by 20 cents.
The live price is $50.20. NAV is $50.
The AP goes into the open stock market, buys up all the individual apples, oranges, and bananas.
Literally buying the raw underlying stocks.
Right, for their true value of $50. They gather a massive block of these stocks, usually 50,000 shares, called a creation unit. They deliver it directly to the ETF issuer's vault and say, here are the ingredients, create brand new ETF shares for me.
The issuer takes the fruit, locks it in the 1940 Act vault, and hands the AP a massive block of brand new ETF shares.
And what does the AP do with those shares? They immediately turn around and dump them onto the live retail exchange, selling them to day trading Dave for the inflated price of $50.20.
Oh, wow. So the AP bought the ingredients for $50, swapped them for an ETF share, and sold it for $50.20. They just pocketed a risk-free 20-cent profit per share.
That is arbitrage, free money. But here's the brilliant part. What is the effect of them dumping 50,000 brand new ETF shares onto the open market?
Well, Economics 101. They are drastically increasing the supply of the ETF. When supply floods the market, the price drops.
Exactly. The AP's massive sell order crushes that inflated $50.20 price, driving it straight back down until it perfectly matches the $50 NAV. Their greed acts as a gravitational pull.
That is just an incredibly elegant system. And I assume if the ETF is trading at a discount, they just run the machine in reverse.
Right, called redemption. They buy the cheap ETF shares on the open market, reducing supply and driving the price up, and hand them back to the issuer in exchange for the physical fruit, which they sell for a profit.
But wait, I have a major question here. The AP is handing a massive basket of stocks to the issuer, and the issuer is handing back ETF shares. There's literally no cash changing hands.
You've just stumbled onto the single greatest advantage of the ETF structure. It's called an in-kind transaction. They're swapping securities for securities. And this is exactly why buy and hold Betty is absolutely obsessed with ETFs.
Let's dig into the tax implications of that, because taxes destroy compounding. If I own a mutual fund and that fund bought Apple stock 20 years ago, there's a huge embedded capital gain. If day trading Dave decides to cash out his $10 million position from my mutual fund today, what happens?
The mutual fund manager has to raise cash to pay Dave. So they hit the sell button on that Apple stock, which triggers a massive capital gain.
But Dave is the one leaving.
Doesn't matter. A mutual fund is a pass-through entity. Any realized capital gains inside the fund must be distributed to all the remaining shareholders at the end of the year.
Wait, really? So I could get hit with a tax bill in December for a gain that happened over the last 20 years just because Dave left?
Yes. You pay taxes on phantom gains you never actually experience.
That is structurally infuriating.
It really is. But now look at the ETF. When the AP redeems shares, the ETF manager doesn't sell Apple stock to give the AP cash.
Right, because it's an in-kind transaction. The manager literally just hands the physical shares of Apple directly to the AP.
Exactly. No cash sale occurs. And under the U.S. tax code, an in-kind swap of securities is not a taxable event. The ETF flushes its lowest cost basis shares out of the portfolio by handing them to the APs without ever triggering a capital gain for Betty.
It's basically a legal loophole. Betty gets to sit there for 20 years without a surprise tax bill. Do we have data on this?
Oh, yeah. In 2025, a whopping 52% of mutual funds paid out a capital gains distribution to their investors.
More than half.
Yep. Do you know what percentage of ETFs paid a capital gain? 7%.
Just 7%. That's incredible. Okay, so put yourself in the testing center. How do test writers try to trap you here?
Trap number 1. They'll try to blur the lines between retail investors and APs. They'll ask, Dave's ETF is trading at a discount. What action should Dave take to realize an arbitrage profit?
Dave can't do a damn thing. He's a retail guy trading on his phone. Individual investors never participate in creation and redemption. Only APs deal with the issuer. Dave is trapped in the secondary market.
Spot on. Trap number 2. They'll ask why ETFs are more tax efficient than mutual funds. The tricky answers will be because they track passive indexes or because of low turnover.
But those are just side effects. The true mechanical reason is the in-kind creation and redemption process. You have to isolate that in-kind mechanism.
Exactly. And trap number 3. The exam might ask if ETFs offer volume discounts like breakpoints, letters of intent, or rights of accumulation.
Oh, right. Those are Class A mutual fund exclusives. ETFs do not offer volume discounts.
Never. Okay, let's transition. We know ETFs hold actual fruit, but who decides which securities go into the basket?
Right, because we have active ETFs and passive ETFs. Picture a passive ETF as a massive commercial airplane flying entirely on autopilot. The goal isn't to find a secret shortcut. It's just to follow the pre-programmed flight path exactly.
And that flight path is a benchmark index like the S&P 500. A passive ETF doesn't use human analysts. An algorithm just mechanically buys the exact components. Brainless, but very cheap.
Extremely cheap. Expense ratios as low as 0.03%. And because the autopilot only trades when the index changes, turnover is minimal. But what about the active ETF?
That is an airplane with a live pilot at the controls. A human portfolio manager making real-time decisions, trying to find mispriced assets.
And their goal is to outperform the benchmark.
Outperform. That's the golden keyword. If a question uses outperform, beat the benchmark, or alpha, it's pointing to active management. But that live pilot costs money. Active ETFs have higher expense ratios, like 0.2 to 0.75%, and higher turnover, which eats into their tax efficiency.
Okay, let me push back here. Active ETFs are more expensive than passive ETFs. But how does an active ETF compare to an actively managed mutual fund? They both have human pilots. Shouldn't they cost the same?
This is a massive gotcha alert. Logic says they cost the same, but the active ETF will almost always have a lower expense ratio than the actively managed mutual fund.
Why? Where are the savings coming from?
The plumbing. A mutual fund has to manage thousands of retail accounts, process Dave's $500 buy order, mail out tax documents, handle customer service. That administrative overhead is enormous.
And the ETF doesn't deal with any of that. The ETF issuer only deals with the APs moving 50,000 share blocks. All the retail noise is pushed off to the brokerage firms.
Exactly. The ETF's internal operations are just structurally cheaper to run. Oh, and one more thing, if an exam question just says ETF without specifying active or passive, always assume it means passive.
Assume passive. Got it. All right, take a breath, because we are leaving the safe, fruit-filled world of the 1940 Act, and we are entering the danger zone.
Here we go.
We established that an ETF legally must hold physical assets. But what if you want to track a complicated commodities index and the issuer offers you a product that holds absolutely nothing? Zero underlying assets. Welcome to the terrifying world of exchange-traded notes, or ETNs.
This is where bankrupt Bob comes back in. Bob sees Dave wants to invest in an obscure index. Bob says, instead of me building an ETF and buying the actual fruit, how about I just write you an IOU?
And that IOU is the ETN. Let's define this legally.
An ETN is not an investment company. It is not regulated by the 1940 Act. It is regulated by the Securities Act of 1933.
Wait, why the 1933 Act?
The 1933 Act is about transparency in issuing new securities requiring a prospectus. But it does not require a board of directors, and crucially, it does not require the issuer to hold assets in a secure vault.
So Bob's ETN is literally just a piece of paper.
Legally, it is an unsecured debt obligation, a senior note issued by a bank with a fixed maturity of 10 to 30 years.
I have to push back hard on this. Dave gives Bob 10 grand to buy this ETN, and Bob doesn't use the money to buy the underlying stocks. What is Bob doing with the money?
Bob takes Dave's money and uses it to fund the bank's other operations, pay executive bonuses, whatever. It's an unsecured loan to the bank. Bob just promises to pay Dave a return equal to the index.
Why would Dave or anyone willingly accept an unsecured IOU instead of demanding the actual 1940 Act fruit basket.
The benefit is no tracking error.
Let's define tracking error quickly.
An ETF has to physically buy stocks, pay commissions, hold cash for redemptions. Because of this friction, the ETF's return will wobble slightly away from the pure mathematical index. That wobble is tracking error.
Like trying to trace a drawing by hand. You're going to wobble off the line a bit.
Right. Institutional investors hate tracking error. So bankrupt Bob says, buy my ETN. I'm not buying messy stocks. I'm giving you a contractual promise. If the index returns exactly 12.54%, I will pay you exactly 12.54%. Zero tracking error.
Okay, I see the appeal. But the elephant in the room is the word unsecured. The promise is perfectly accurate, but it's only as good as bankrupt Bob's wallet.
And that is the massive risk, credit risk. There is no vault of fruit to protect you. If Bob's bank goes bankrupt, you don't get the index returns. You lose everything. You're just an unsecured creditor in bankruptcy court.
Which brings us back to our opening story, September 2008, Lehman Brothers.
Right. Lehman had a massive ETN business. Investors bought them to track agriculture or commodities. The underlying indexes were doing perfectly fine. The price of wheat was holding steady.
But the entity making the promise, Lehman Brothers, imploded and filed for bankruptcy.
And the ETN investors. Because the issuer defaulted, the notes were worthless. The investors were completely wiped out, even though their thesis on the agriculture market was completely correct.
So listen closely. Okay, pop quiz. If an exam question mentions unsecured debt, fixed maturity date, or issuer bankruptcy,
you instantly click ETN, not ETF.
Exactly. And this leads perfectly into the ultimate showdown. The SIE exam loves to pit ETFs and ETNs against each other. Let's do a direct side-by-side breakdown. Structure.
ETF is an investment company, a fund. ETN is unsecured debt, a note.
Regulatory.
ETF is the 1940 Act. ETN is the 1933 Act.
Maturity.
ETF has no maturity. ETN has a fixed maturity of 10 to 30 years.
Okay, here is the number one tested distinction and my favorite memory trick. ETF. The F stands for fund. A fund holds real physical securities, so there is no credit risk. ETN, the N, stands for note. A note is debt. Debt is just a promise, so it carries credit risk.
That is perfect. And the exam trap here is that they will try to confuse tracking error with credit risk. Do not mix these up.
Right. Tracking error is ETF risk. The fruit mix is slightly off. Credit risk is ETN risk. The grocery store burns down, and your IOU is worthless.
Exactly. If the question says, the portfolio's return may not perfectly replicate the benchmark, that's tracking error. Point to the ETF. If it says the investor's principal is subject to the financial health of the issuer, that's credit risk. Point to the ETN.
Awesome. All right, let's shift gears. We've built the vehicles, but how much does it cost to drive them? Let's talk fees. I like the toll road versus subscription analogy.
Lay it out.
If you buy a traditional class of mutual fund, it's like a subscription. You pay a big upfront fee, a front-end load of maybe 4 or 5%, but once you're in, there's no per-trip charge. You transact at the pure 4.00 p.m. NAV.
Right.
But an ETF is a toll road. No upfront monthly pass, no sales load. But because it trades on a live exchange, you have to pay a small toll, the bid-ask spread, every single time you trade.
The market maker takes a tiny cut to compensate for providing liquidity. They buy slightly lower than the true price and sell slightly higher.
So let's look at buy and hold Betty. She has a $50,000 lump sum, wants to invest once, and hold for 20 years.
For her, the ETF is mathematically superior. She takes the toll road exactly once, pays one bid-ask spread, and then enjoys the incredibly low ongoing expense ratio for decades. The mutual fund's 5% front-end load would have crushed her capital on day one.
But what about dollar cost averaging Dave? He invests exactly $100 every single week.
This completely inverts the math. If Dave uses an ETF, he drives onto that toll road 52 times a year. He pays that bid-ask spread toll every single week. He's bleeding cash. For Dave, a no-load mutual fund is actually mathematically cheaper.
This sets up 3 massive exam traps. Expert, take us through them.
Trap 1. Lower expense ratio automatically means lower total cost. False. As we just saw with Dave, frequent investing means the ETF spread cost can overwhelm the lower expense ratio.
Trap 2.
12B1 fees. These are marketing fees up to 1%. They are a mutual fund concept, not an ETF concept. ETFs don't charge 12B1 fees.
And trap 3.
Commission-free trading means cost-free. False. Even if your broker charges 0 commission, the bid-ask spread always exists on the exchange. The toll road is never totally free.
All right, we are in the home stretch. Let's finish with the most dangerous toys in the ETP toy box. Day trading Dave wants to get rich quick, so he discovers leveraged and inverse ETFs.
These are highly scrutinized by regulators. A leveraged ETF uses derivatives and borrowing like swaps, options, futures to multiply the index's return, like 2x or 3x.
And an inverse ETF aims to deliver the exact opposite of the index for bearish speculation, like negative 1x or even negative 3x inverse leveraged.
Right.
But there is a deeply mathematical problem here that destroys long-term holders, the daily reset. Explain why these are so dangerous.
The stated multipliers say 2x is only valid for a single trading day. The fund's swap contracts settle and reset their baseline at the close of every session. This creates volatility decay or compounding decay.
Let's walk through the $100 example slowly. Dave buys a 2x leveraged ETF for $100. The underlying index is at 100 points. Day one, the index drops 10% to 90.
So Dave's 2x ETF drops 20%. 20% of his $100 is $20. His account falls to $80. The fund settles and resets.
The day two, the index bounces back up 10%. From 90, a 10% gain gets it to 99 points. So over 2 days, the index is basically flat, down just 1%.
But Dave's ETF aims to double that 10% gain. It needs to gain 20%, but it's gaining 20% on the new beaten down base of $80.
Right. 20% of $80 is just $16. So $80 plus $16 means Dave's account lands at $96.
He lost 4% even though the index is basically flat. The daily compounding literally eats the mathematical value alive in a choppy market.
You brought in some shocking real-world data from FINRI Notice 0931. Lay it on us.
Between December 2008 and April 2009, the Dow Jones Oil Index gained 2%, but the 2x leveraged ETF tracking it fell 26%.
The index went up and the 2x ETF went down.
Yes, and the negative 2x inverse ETF fell 26%, but the worst one, the Russell 1000 Fin, gained 8%. The 3x ETF tracking it fell 53%. And the negative 3x inverse fell 90%.
Wait, so the exam trap here. In volatile markets, both the leveraged and inverse versions of the same index can lose massive amounts of money simultaneously.
Absolutely.
So if the exam asks if a 3x leveraged ETF is suitable for buy and hold Betty's long-term retirement account, what do you say? Pause in there.
Absolutely not. They are only for sophisticated short-term trading.
Never for long-term holding.
Okay, rapid fire recap time. Top testable takeaways. ETFs, 1940 Act, actual securities, in-kind tax efficiency.
ETNs, 1933 Act, unsecured debt, massive issuer credit risk.
Tracking error is ETF, credit risk is ETN.
ETPs trade intraday at market price, mutual funds trade once a day at NAV.
And leverage inverse ETFs reset daily and will suffer volatility decay over the long term. Boom.
Before we sign off, I want to leave you with a final provocative thought beyond the exam. We talked about how passive ETFs are like airplanes on autopilot, just blindly buying the index.
But what happens when the vast majority of the world's money is on autopilot? If everyone is passively buying the index, who is left doing the critical thinking to figure out what a company is actually worth?
Oh, wow. If true price discovery dies, how fragile does the whole system become? That is a wild thought to end on. But hey, thank you so much for joining us in this deep dive. Keep reviewing those concepts, keep drilling those practice exams, and go crush the SIE.